Welcome to the Big Mike Fund podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in, because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fund podcast. I'm the Big Mike.
Mike Zlatnik, and today it is my pleasure and a privilege to welcome back Jeremy Roll. Hey, Jeremy.
Hey, Mike, thanks again for having me back. I appreciate it. Looking forward to our conversation as always.
Thank you so much for coming on a podcast. You've come in the past. You've shared great wisdom. You are one of the best guests to have. So I'm so honored and humbled. And thank you so much for coming.
Absolutely. And I really hope, thank you for everyone who's watching. I hope this is helpful for you guys today.
Yeah, thank you. So we are recording this in early December. We're post-election. First question is, what's your impression of the election? What are your feelings about the new administration? And the most important questions for the audience, is this good for commercial real estate or not?
Yeah, very good questions. So first of all, I should tell everybody out there, I don't vote. I personally think that most, if not all, politicians are not in it for, to help everybody necessarily, but I think a lot of them are unfortunately, taking deals, doing things on the side. So I don't have a high regard for them, but so I also want to say that I'm not with any particular party. So that's the most important thing. So from a business perspective and trying to be objective about it, I would say that probably, given that Trump is pro-business, I would imagine that's going to trickle down into like pro-real estate. Now, real estate is, first of all, there's single family, there's commercial, and a lot of it hinges on interest rates and the economy, et cetera. What I think is that, and of course, this is subject to change, but this is my best guess right now, and I may be wrong, but I think that Trump will be very good for business and real estate in years 2, 3, and 4. I think year 1 is just going to be, I've done some research, and essentially any incoming president who has to come in and enact new policies, get them passed, that doesn't always happen immediately. They have to take effect. There's a lagging effect on those things taking effect in terms of, permeating into the economy. So I'm going to call it a 1-year lag effect, not just lag, but also passing time effect, some of which won't pass, right? So he's generally pro-business, but I don't think he'll be able to do much for 2025 overall. I could end up being wrong. And in the meantime, I think there's just so many indicators showing the very high probability of recession still. I don't think he'll be able to do much in time to avoid that. The other thing is, I did a lot of research showing that I don't think there's ever been a president who has come in on such a long yield curve inversion and other metrics that have been going on that are kind of all lining up with very high probability of recession, where they've been able to actually stop it because for the lagging reasons and everything I just mentioned, right? Not the least of which is they have to get things passed and approved, which not all of them are going to be approved. So that's my long answer to you. I think it'll be good for business and real estate in the kind of medium to long term of the presidency, but in the shorter term, I don't think it's going to really have much of an effect.
Yeah, it's a lot of great wisdom. I'll just add a little bit of commentary. Yes, everything has a lag effect, and it takes time. Like the Fed policy changes, everything has long and variable lags. So anything they enact, and he does have Congress. He does have both ballots, the House and the Senate, and that gives him a little more ability to act faster. Plus, he has to enact a lot of his changes in the first couple of years, because midterm elections, things could change. From that perspective, I think that's why he's going to go with very aggressive agenda. At least that's what it feels like. They are firing on all cylinders. He's barking at tariffs. He is just dodge. All this stuff is all happening all at the same time. This is not preach a lot of change and change one thing at a time. It feels like preach a lot of change and change a lot of things at the same time. That's what it feels like.
I agree with you, and I do agree that it's a big difference that he's got the House and the Senate. What I will say, though, is for anyone who's thinking to themselves, okay, Trump is very pro-low interest rates, so he's going to basically pressure the Fed and possibly even change Powell, because Trump actually appointed Powell, for anyone who remembers. And so even if he changes Powell, and even if the Fed goes to reduce interest rates, you have to remember there's an 18 to 24-month lag in those rates, right? Really permeating the entire economy. I'm not saying it won't have shorter term positive effects on real estate, but I don't think that'll be enough to really, again, to stave off what I think is ahead of us in terms of high probability of recession.
And I appreciate the bold statement. If you follow the Wall Street, there's a feeling of euphoria that things are going so great. It's just going to be nothing but significant ride from here, and these big bankers are predicting stock market to continue to keep climbing. It's of course it benefits them, so they'll keep selling the stocks, they'll keep selling the funds, they'll keep the talk that benefits them.
Yes.
What is it, the bias called? It's called affirmation bias.
I think so. Yeah. Yeah. But I just want to point out, I'm sorry to interrupt you, but take a look at Goldman Sachs, who just a couple months ago issued a forecast that they're expecting the 10-year average annualized return of the S&P 500 to be 3% annualized. And the reason, what they're telling you when they say that is that we now had a major run up. We're at the end of a cycle. There's going to be a correction or a crash, and there's going to be a lost decade, which happens after you get to these types of valuations. That happens typically every time. And so they're telling you, even though most analysts are obviously very positive, the stock market's up. If you read between the lines of what the forecast is from Goldman Sachs, you'd understand that there's a lost decade that they're forecasting ahead for, and that's how that happens. It doesn't just happen because the stock market stops at this level and only goes up 3% thereafter. That's not what happens.
Yeah, there's of course a lot of volatility. You may still have a great run, but there may be a correction down. The economy could hit a recession. So let's kind of brainstorm a few possible scenarios, right? So some of the Trump policies, at least the talk has been very inflationary. Tariffs are certainly scary and inflationary. It's an additional tax, it'll increase the prices. If you think about Dodge, it's smaller government, more efficiency, it's deflationary. Obviously, Trump is a real estate investor of many years. He wants low interest rates. I don't know what kind of practical influence he could have on Powell, but one way or the other. What do you think? Inflation, deflation, what happens? What sort of accelerating inflation, high interest rates, or we actually hit recession, decelerating inflation, we're now into more low interest rate environment. Let's talk about each of these scenarios. What's a greater possibility, and what happens with the commercial real estate in each one of these use cases?
Yeah. So, well, let me just start off by saying that I don't think it's a coincidence the Fed is reducing rates. The Fed knows the data, understands how all this stuff works. People are saying, how are they reducing rates with the stock market going up and with the economy being okay and everything else? The underlying fundamentals of the economy, those are all like basically backwards looking data. The Fed understands what is likely to come from a probability perspective. So let me give you an example. There was an ISM. So probably most of you are out there aware that the goods manufacturing in the US has been in a recession for a long time, meaning under 50 on the ISM goods print. ISM services and our services have been keeping us in a really strong economy. That's what's been really strong. People have shifted to spending on services in the past couple of years, right? Now, some of that money is now tapered off with stimulus and everything else. But the ISM report just came out this week, and it was surprisingly much lower. So I believe the ISM print was last month 56, is now 52.1, if I have it right. Below 50 is contraction. Below 50 is recession, contraction in that half of the economy. The ISM hiring was 53, went to 51. None of this was expected, by the way, by the analysts. So I would tell people to watch that very carefully, because the only thing that's been holding this up, there's only two things holding up the economy right now. One has been services for a long time. And if that continues to go, and it might be a 1 month phenomenon, but if it continues to go in that direction, and I would watch it after the holidays tend to mess everything up because there's a lot of spending that occurs in the holidays. But once you get rid of that noise, I would watch that in the first 3 months of 2025. And I would also obviously watch the unemployment rate, which is expected to tick up tomorrow when that data comes out. That's the most telling of a potential recession. Then I was going to say the other thing that's keeping this economy up is that Biden had actually increased government spending by 25% this year compared to last year. And in fact, if you remove all the government hiring, okay, for 2024, we would actually be at negative private payrolls increases, meaning there would have been a net lost jobs, negative lost job or negative jobs growth on the private side. So that was probably done because of an election year, and that's probably going to go away. And in fact, as you mentioned, it's going to be the opposite under Trump, where he's going to try to cut some of the fat of the government, right? How much he'll do and how quickly he'll do it remains to be seen, right? So those are some just general thoughts about where we're potentially heading, because I just don't think it's a coincidence that the Fed is reducing rates. They know something, obviously. Now, if you think about that scenario, and if we end up in a recession, then typically you're not fighting inflation in a recession. You could have stagflation, But right now, if you take a look at the main component that's still driving, that's still keeping inflation high, it's the owner's equivalent rent, which is the most crazy and ridiculous metric that they use. And I'm sorry if that's a little extreme of a statement, but they don't use the actual rental data. They survey owners. You should, if you're not familiar,
Affordability of housing. That's what it means. In simple terms.
It's crazy. And so it lags. That's a huge lagging indicator that's still yet to come down fully. And that part is over 5% currently. And it's such a huge composition of the index. I may be wrong, but I think it's like 40%. And anyway, it's a very big percentage. And that is what's still keeping the general inflation data up from what I can see. Now, that's not to say there aren't things that are still very inflationary. Car insurance is inflationary because it lagged a lot. Home insurance was inflationary. Certain foods are like eggs are up 10% this year. Like there's certain ones, but there is a lot of stuff that's balanced itself out. Cars, for example, car prices are very much down. So you have to look at the whole bucket. So to me, the highest probability scenario is that we end up in a recession. And when you think about a recession, what you should expect is a stagnant economy. It's possible we'll still have some lingering inflation because of the way that inflation is measured. So that's kind of how I see the highest probability scenario. Of course, anything can happen. I don't know if you want to go down the path of the others.
Well, let's just dissect a little bit. So if we go into recession, which you are pointing out, I've been a proponent of this idea too. The election year shenanigans and overblown spending and just trying to stay in power, of course, all that is coming to an end for Biden. But on the other side, Trump's view, exactly as you said, they're gonna start cutting, but it's all lag effect. So we might see a recession post New Year's. It's almost like all good holidays, the election, the party is over, and then there is a hangover, and then the recession comes. In that scenario, what happens for commercial real estate?
So yeah, so that scenario
start coming down, 10-year Treasury yield. Are we going to see some level of relief in the cost of financing?
Yeah. So in a recessionary scenario, there's kind of a recession playbook on the commercial real estate side. So what you end up happening is you have businesses slow and lay off people and close. You have increased vacancy as a result, right? You have reduced occupancy rates, and you have a reduced NOI because expenses don't typically go down. They may not go up as quickly as they were before, but you're dealing with reduced net operating income. And even at the same multiple or cap rate, the value of the building is lower that you could have bought a year ago, right? Because it's not producing as much profit. The problem right now is that with inflation, it's possible the Fed could keep the rates the same. And now you're kind of gotten, okay, same multiple, lower value, you got lower NOI, you got a lower value. But there is a possibility interest rates could go up. That means that the multiple actually goes down more typically, right? The cap rate goes up. And then you have a compounded effect of lower net operating income compounded by a lower multiple people are willing to pay. Now that can happen during recession because you're going to have a lot less liquidity on the equity side and the debt side. So it's going to be harder to buy stuff. It's going to be much harder to sell stuff. And that basically, when it's harder to sell stuff, you have pricing power on the buy side, right? So it's very possibly a bit of a compounded reduction in the value of the real estate. And then of course you have interest rates coming down. The Fed will continue to reduce rates. So what I think will happen is that we have had a lack of a lot of positive leverage for real estate investors. And that's actually what's kept me very much on the sidelines for a number of years now. It's really bothered me because that means we're not getting compensated for the risk with return commensurate with the risk, right? There's no positive leverage. In fact, there was negative leverage for a number of years. Now we're kind of like at even a little bit below or a little above, depending on the deal you're looking at, unless you're looking like a Class C type of property in a C market, a different story. I think what's going to happen is that you're going to see interest rates come down at the same time. Cap rates may be flat or a little higher, and you're going to have that spread open up so that investors will finally get back to the 125, 150 basis points, roughly, depending on, I invest in Class B, B+, that's where I think it should be. And that is when you have the final reset for the cycle, along with the reduction in NOI from the recession. So to me, I think I mentioned this last time, there were two dominoes meant to be fallen to have a full cycle reset here. It was increased interest rates, which we all know has happened, and then the recession, which is how you have the final cleansing and reset with that recessionary playbook I mentioned.
So in that scenario, what you're just stating out, we're not at the bottom yet. We are forming a bottom, but the bottom will be formed effectively when we see a real recession, which will hurt NOI, while the interest rate reset may be delayed. It's a function of how fast the rates will move, right? If the rates move down faster, then it may compensate for lower NOI, but there may be a period of time of extremely, I guess, good deals are really happening because reduced
Yes.
NOI and cost of money is falling.
Right. You can't assume that just because interest rates are going down, that people are going to pay more because they're increasing their multiple. You have to assume that interest rates go down, but at the same time, people are scared. There's less liquidity, and basically, people are going to get a better multiple or better price in bad times. So you get as an investor, that's how the positive leverage gap opens up, right? The interest rate goes down, but the multiple may not change or may even get more favorable.
So the positive leverage you're talking about between the cap rate and the mortgage rate?
That's right. The interest rate and the cap rate, that positive spread that we just haven't seen for a while, which was telling us that things were very expensive.
Yeah, of course, it makes sense. And then let's just quickly dive into the other scenario. What if it doesn't happen? What if the recession doesn't really take place? We wind up sort of seeing that the US economy is just too resilient. It's still the best place in the world. You still have, I don't know, AI-driven investment, a number of other things that continue to propel the economy, the wealth effect of the stock market, where people have appreciated portfolios, right? So recession, theoretically, we talked about it, but it's been a much more quiet conversation recently because of all the good news that's been happening on the stock market, crypto, all other stuff. So it doesn't feel like recession is coming. So let's go look at the other scenario. What if it's not coming? If it's, I don't know what they call it, soft landing, or people are working, unemployment ticks up a little bit, but it doesn't really get too difficult. So do we have that scenario as a possibility? Is this something you consider, and what do you think about that?
Yeah. So let me. I actually have some notes because I normally memorize this stuff, but this is so important right now. I didn't want to get it wrong, so I'm going to read some data because I'm sure there's a lot of people out there listening to this saying everything looks great, just like Mike just said, and we probably should have had a recession by now. There hasn't been one, and it's just going to keep going fine. Okay, so I'm going to read this to everybody. Because to me, this is why I think the probability of recession is less than over 90%. And a soft landing, by the way, in general, historically, is maybe a 20 to 25% likelihood. But when you actually then layer all of this data on, it's much lower. So let me read this to you, okay? So on average, it takes 26 months from when the Fed first raises rates, which was in March of 2022, until there's a recession, on average. That would have implied a recession starting in June of 2024, okay, just a few months ago. But there's two reasons why that's taken longer this time, in my opinion anyway. Number one is that we had a lot of stimulus money that was just basically wearing off at the end of last year that basically postponed the possibility of recession because there was so much spending into the economy. And two is because we talked about before, Biden just increased government spending by 25% this year alone to help stave off a recession for the election. So as we've discussed, both of those are now gone, right? So even though it feels like we should have had a recession and it's probably too late to have one, we're only a few months past the average. Plus we have all this very odd stimulus we wouldn't normally have. So it actually makes sense that it's taking this long, and it's a question of having a lot of patience more than anything. So that's number one. We're actually nowhere out of the woods of being within a recession timeframe that makes perfect sense, okay? Number two, the most reliable indicator we have of potential recession coming up, which has been correct every single time for over 70 years, is the Conference Board Leading Economic Indicator, the LEI. So when it goes below negative 4.5%, there has always been a recession thereafter, every time for over 70 years. The LEI had its longest ever negative reading as of June of 2024. So it actually set a record, okay? It was -6 at the time. This implies essentially a 100% chance of a recession. Now, of course, we know that's probably not accurate, but it's a very high percentage, right? Another metric has literally been a perfect forecaster of recession is unemployment, okay? So if you look at the U3 and unemployment rates, every time both have increased more than 10% from the bottom, which our bottom was 3.4%, now we're at 4.1, and I think we're expected to be at 4.2 tomorrow when they have the print. Every time there's been a recession within the next 12 months, every time for 60 plus years. So that implies that we should have a recession by the end of Q1 2025 because both were in that increased category by the end of Q1 2024. Okay, to your point, that's very soon. Of course, I'm not saying that's going to be a perfect indicator, perfect timing indicator. None of these are meant for timing. These are meant for probability of recession, right? So we have one metric at 100% accuracy, another one at 100% accuracy. Another one is the 3-month and 10-year yield curve inversion. It's only at a false indicator once in 60 years, plus years, okay? And we've had that inverted, and that's still inverted right now, and that is almost flawless indicator. So now you have 3 that are almost 100% probabilities together at the same time. Okay. So, and my other note was why there hasn't been a recession, which we already talked. There's actually others. I didn't want to go on for 10 minutes. Okay. But the point is that if I give you 3 indicators, 2 of which are 100% correct for the past 7 years, and 1 of which is probably 95% correct for the past 60 years, you have to understand, and I tell you that we're still within a normal recession window time frame, even though it feels very long. You have to basically, as an investor, be very cautious. There's just no other way around it. I'm not saying that the recession is going to happen. That's why I say it's over 90% and not 100%. But I have a very hard time. Like, there's no bet. If you put a gun to my head and made me make a bet, there's no doubt I would take the bet on the recession just because of the probabilities, right? So again, it's not impossible that there won't be a recession, but you have to, if you want to be careful as an investor, you have to assume there's going to be one.
Yeah, appreciate that. It's just mathematics, right?
Yeah.
I'm a mathematician by education, and statistically, what you're saying is it's very simple. You have enough data that statistically recession is very, very, very likely. You don't know exactly when it's going to happen, but it should happen soon. And there's some volatility in outcomes, results. There's all kinds of unknowns. But it's just inevitable question of time, and it feels like post-election, post-holiday spree, maybe Q1 is
and I want to add one more thing, and I don't disagree with it, but it's so hard to forecast the timing. I don't want to put a time frame on because it's so hard. But one more thing I'll add is that
it's 2025. That's what your data is saying. It's 2025.
Most likely, that's the probability. Yeah, that's the probability. But also, we had a record long yield curve inversion, and there's actually a direct correlation between how long the yield curve is inverted and how big of a stock market crash we have. Unfortunately, that's not in our favor right now, because if you look at the charts, and there's a direct proportional relationship, we're due for a 45 to 60% stock market crash based on history. Okay. So again, I can't tell you if that's going to happen. And one wild card could be if Trump comes in and just prints a ton of stimulus money, which maybe hasn't been a factor in some of that data in the past, maybe it'd be less. But we're due for a very severe contraction on the stock market side. And by the way, it makes sense because the longer the yield curve goes negative, the higher the stock market goes before it corrects. And therefore the correction back to the mean would be more, right? So
reversion to the mean, good old rule, but it has to revert to the mean.
Yeah. So let's quickly touch upon, you asked me about what if there isn't a recession? Well, if there isn't a recession, then we're probably going to have a lot more of the same. The stock market will creep up slowly over time, or maybe not so slowly. We would expect to have either, flat or slightly positive or slightly negative leverage, which is not good for investors. And it'll be a tough time to invest, to get yield, to get cash flow, because we hadn't had the full cleansing of an end of cycle reset. And that hasn't happened really since 2009, which is a record long time. So
that leads me to the next question, right? So the scenarios you pointed out are obviously a lot more likelihood of recession. No guarantees, of course, but it's a likely scenario. And then if things don't go that way, then we can a little more longer of what we have today, and at some point the journey will end. All good things must come to an end. That expression is from Star Trek. when a Q godly being is about to destroy humanity, and just says all good things must come to an end. So it's almost inevitable that the bull run will stop at some point. So sooner or later it will happen, and the more it runs, the higher the chances. The risk reward ratios just shifting at some point. So all that said, what should investors do? You're not giving investment advice.
Yes, no,
we can talk about what would you do. How about that?
Yeah, well, I'll tell you what I am doing. And as Mike mentioned, I'm not an investment advisor, financial advisor, accountant, or attorney, or anything. So do your own research. This is not investment advice. I am on the sidelines unless there's something really, really unique that I think will work very well in a recession and it won't be subject to too much either asset value reduction or risk of reduced cash flow. I am heavily on the sidelines. This is the most heavily on the sidelines I've been since 2005 to 2008. The cash I have is in treasuries, and they're in short-term treasuries. It's been 3 to 6 months for the past couple of years that with the cash I had. Now I'm like 6 to 9 months trying to front run further reductions in the treasury rates in case they happen. But that's what I'm doing. I've laddered them, meaning I buy every couple of weeks and then that turns over in the same amount of time. So just constantly buying at different times just to average in. It's not, for someone in California like me, it is somewhat helpful. There's no state tax on treasury gains, in my understanding. So it is helpful for someone in a high tax state, but it's not great because it's really not getting you very ahead. And some would argue you're still behind because the real inflation isn't what the government prints, right? So, but it is maybe a good temporary measure, because if you, honestly, we know that cash is king in bad times. That we know. That's not a question. And so if you think there's going to be bad times ahead, that may not be a bad plan. There's other things you can do. You can do similar like money market accounts or other things you can do. And certainly if you're willing to take more risks, there's other short-term stuff you can look at as well.
Understood. So you're still on sidelines, still because you're ultra conservative. You're one of the most conservative investors that I know, and
yeah,
you're still very, very cautious.
Yeah.
I can sort of add this comment that are you playing around with any private debt? Because the banks pulled out. I'm just trying to sort of brainstorm what we've seen. It's a good time to be a lender if you don't want to play equity, which you're basically pointing out. You're not yet comfortable to go into equity unless there's a really great deal, and you really have to see a phenomenal great deal. But we'll leave that aside. Are you playing in debt, primary debt, mass debt, secondary debt, anything at all? Do you think it's the right opportunity? Because if you, how do you enter into equity when you don't want to enter into equity? Sometimes you do it through debt. You loan, not necessarily loan to own, but you have that possibility. If you don't get paid, you got to be in a position where your loan takes out the equity, right?
Yeah. So there's 1,000 ways to invest. None of them are wrong. What I personally do is look for very predictable, stable cash flow. I want to go to sleep tonight, wake up tomorrow, and not much has changed. So I live off the cash flow. So for me, the concept that I can lend maybe at a lower loan to value and know that I have the backup of taking over the asset, it is not a good fit for me. It could be a good fit for a lot of people. It's not a good fit for me because that is not predictable cash flow. That is maybe still safe scenario and investment, but not predictable cash flow, because the cash flow can stop when you're taking all that over, right? And it could get messy and all this type of stuff. So it's not the right fit for me. I do agree that a very low loan to value scenario could make sense for some people. I stopped doing my hard money lending. This is how conservative I am. Literally, when Powell raised rates for the first time in March of 2022, I stopped I've been doing hard money lending consistently all year, every year since 2009, which is basically, I was lending first position loans to people flipping homes at maybe 60, 65% loan to value. I stopped, let it all roll off by the end of the year, and I'm waiting to get back into it, but I won't even do that because, again, I'm looking just for the predictable payments. I don't want to take the home over. I may make more money in the end, but I need the predictable cash flow, and not necessarily the safety isn't good enough for me. I want the safety and the predictable cash flow.
Yeah, that's the ultimate conservative view. You want predictable cash flow, but you're settling for the treasury rates. In the fours and mid fours, high fives. Well,
yeah,
low fives, somewhere on there, and then they expect it to come down as Fed cuts, right?
Yep, I am definitely settling, but it's also putting me in a very good position, cash position, if we do have a recession, because I'd rather then put my money into equity, which is what I prefer, for the cash flow and for maybe some upside, right? Because that's one of the problems with debt. You typically don't get upside. Now, you can get upside if you take properties over, but generally speaking, that's not the business plan. So I'd rather know that if I wait another year and don't get that additional incremental return, I'm in a position to then deploy capital, have a lot of cash to deploy into the equity side at the right timing.
Let me ask you this question. So you're looking for that positive spread. Basically, the cap rate you're buying at on the as-is basis, you want to have a spread over the cost of debt and cash flow from day one, have that margin of safety. So do deals like this exist? Are you seeing any of these deals today where you can actually pick up something like that? And I'm going to ask you the question with the already knowing the answer, because I already have a deal like this.
Okay.
So it's beginning to happen where you can actually pick it up at a price so good that you have a decent positive spread today. It feels like it's, for some situations, it's already the bottom. You're already picking it up at an insanely good price, but that's a very good matrix because you cash flow from day one based on these high interest rates. And this is kind of crazy, but it's already happening.
Yeah, there's two scenarios where I've seen that happen. One in particular that I've done since 2020 that kind of, because of it was a different structure, it happened organically based on the structure, which I've invested in a whole number of tax-abated apartment deals since 2020 with 10-year fixed rate loans that created a positive leverage spread of honestly sometimes upwards of 125 to 200 basis points. Okay. That was based on restructuring the expenses, removing the majority of the taxes, et cetera. So it's a very different structure, right? Probably too complicated again right now, but that's one angle that I'm still looking at today when it makes sense, because it still creates that positive leverage spread. And by the way, though, in my opinion, those buildings are often a defensive play going into recession, which is the other half of what I was really paying attention to, because you're typically the lowest cost units on the block for at least, you know, a certain percentage of units that are low income, right? Or
So
at least
it's considered to be affordable housing to get those credits, and the government gives you the tax abatement.
Yeah, and usually it's 50% of the building gets converted to tax abated, meaning that you have to conform to certain income levels. And when I say low income, sometimes just 80% of the area median income, right? Which is not really, you know, it's not like the low income a lot of people think of. The other thing that I'm seeing, and you're seeing now probably, is there are certain assets and certain unique deals, whether it's a, you know, a very low interest rate assumption, or I'm even starting to see, like, you know, older properties, you know, 70s, 80s, and certain kind of secondary and tertiary locations have very significant positive leverage spreads. Now, the problem for me is that I target specifically newer assets, kind of a B plus asset. So think like at least from the 90s or 2000s, that has a 9-foot ceiling, and it's not the same structure and general architecture of a 70s or 80s building. And so in what I target, it's still hard to find. Like, you probably still won't find that type of positive leverage spread on a normal deal in a decent location. Like, I target a like A minus or B market, right? Not a C market. So it really depends on what you're targeting. And that's just a multifamily example. You know, there are other asset classes, right? I mean, office and retail have done their own thing for a long time now for various different reasons, right? And so you can also look at those, but I'm looking for very predictable cash flow. Those two asset classes are hard to predict the demand for the next 10 years, for example, both of them for their own reasons.
Yeah, I appreciate that wisdom. Just add a couple of comments. We've seen on the retail space, interestingly enough, still really low cap rates on sale about parcels. People are paying lower cap rates than I thought the asset would go for. So retail seems to be, especially if it's like a Starbucks out parcel or one of these companies where you think the credit is so good. And retail, that's what you've seen. You have no supply. You have very limited new supply, and they've done really well with the price per foot, with quality retail leases, just simply because the economy has done well. But you're right. There's some unknown what will happen with a recession, whether you're going to have some tenants leaving, et cetera, et cetera. There's
retail
a little bit of
uncertainty out there. I was going to say, sorry, retail and office are both highly susceptible to recessions. There are exceptions. There are
office is already beaten up. Office is pretty badly beaten up.
You say that, but there's going to be more companies shut down if there's a recession, right? So you have to look at the rent roll, because, like, for example, I'm from Canada. I'm in a very large government, single-story government office building. It was a mall that was converted, where it's 100% government occupied, long-term lease. There's medical, it's like Canada. So there's, you know, the medical system and other offices. That's like, I'm not worried about there during a recession whatsoever, right? But so it really depends on the tenancy. But for the vast majority, you have to be very careful with retail and office in a recession.
Yeah, 100% agree. It's the quality of the lease. If you have a very high quality lease tenant, you almost can't go wrong because of their credit. I mean, they'll pay the lease to maturity. Otherwise, they'd have bigger problems. So it's either government or high quality credit. Now let's go back to the. So I guess you're looking for these tax abated, almost new construction, a fairly new product. To get tax abatement, it has to be new, right? Or you have to convert?
No, it doesn't have to be new. You have to convert in that. Converting just means that you have restricted rents. That's all a conversion really means. But you also have to track it. They have to qualify. Depending on the state, there's certain conditions you may have to submit information to the government. It really depends on each state, and it could even be down to the city and county level. But I'm not necessarily looking for those. It's the only things that I'm necessarily finding that make sense. So I'm not like going around and searching for them, because, to be totally honest with you, I would rather just get into a market rate deal at the right time, because that is going to be the easiest to sell down the road. And I'd rather wait until the timing is right, so that I just de-risk a lot of it, right? I de-risk the possibility of rents coming down, occupancy is going down. I get the right multiple. You want to buy it at the right price. And that de-risks a ton of the future predictability, basically.
So how much more correction in price or value you need to get there? I mean, you either get there by rates falling, right? So your cost of money falls, or you get there by valuations.
But you can get there. But my point is that you can get there by both. So in a recession, I'd expect to get there by both together. And the reason, again, is because I think that interest rates will come down, but you won't have a lot of liquidity, both on the debt side and especially on the equity side. A lot of all this money that's like on the sidelines, that happens every time at the end of the cycle, and then it goes away, right? And so that's going to go, theoretically would go away. That's a recession playbook. Now you have people who are in a better bargaining position to get a better multiple. And at the same time, you're getting a better multiple. Even if interest rates come down, you're still getting a better multiple on lower net operating income, presumably, right? And so you basically have this compounded effect, which is also why you have a compounded risk that if you go into a building today, you went in at the wrong valuation, from a year from now. And that's what I'm trying to avoid.
Well, this is so. It's a great wisdom. It's really mathematical computation. What's the right price you're willing to pay? But what if it doesn't happen? It's kind of one of these interesting conditions where you would absolutely love to pick up with 150, 125 basis point spread on a normal asset in a good market. But that still feels not easy to do unless, again, the rate starts falling relatively fast.
Yep. Yeah. So I don't know if you noticed my reaction. What if it doesn't? I'm like, oh, it doesn't happen. Then, I go back to regular investing and I kind of.
The regular investing is just the very conservative treasury yields. But what happens when the yields fall?
No, regular investing is okay. I realize that positive leverage won't happen for many years, and I decide if that makes sense for me or not. And I'll then I'll have to focus uniquely on tax-abated deals to create the positive leverage. But just for example, right now we're not in regular times because I'm not, because I'm expecting a recession. So I think if we were sitting here a year from now and we're nowhere near a recession, at least the way it looks, I'm going to reevaluate, because the thing you have to understand with the data is that, again, we're in a very normal window right now where recession would occur based on the fact that we were expecting one on average in June, but there was a couple of stimulus measures. So it actually makes sense we haven't had one yet, even though it feels too long for a lot of people. Just the data shows that it makes sense. There is a point at which it doesn't make sense that we didn't have one, like there was a soft landing, right? There's a point, like if you said 5 years from now, we're having the same conversation, I don't think that would be reasonable, right? Just as a very extreme example. So at some point, and for me personally, I'm going to reevaluate at the end of next year, how much longer at that point is it reasonable that we could still have a recession, or are we beyond a reasonable window where I have to say to myself, there won't be a recession? But I'm not worried about that yet. There's plenty of time between now and then.
Yeah, it's I guess it's the data-driven decisions, and this is the most difficult part. It is, as much as we're trying to look in the past to see if this cycle is like all the past cycles, but this cycle is a different cycle because of a number of other factors, many factors, the COVID, the government spending, the size of the national debt.
Mike,
I don't know, they're talking about whether you have any comments or thoughts on this, just a little deviation, but we have a great conversation. They're chatting about cutting $1 trillion out of $2 trillion budget gap somehow getting the national debt under control. And that feels so difficult. You really have to cut. I mean, there's probably so much fat, but when you cut all that fat, what happens? You just laid off a whole bunch of people. You're going to be sinking the economy. You're going to be hurting the. I'm just trying to think, how does it work? Maybe we've held up so much because of the government spending. The government spending as a percent of GDP has been going up and up and up. But when you reduce that, then you really force a recession.
That's right. You're 100%. So what Trump is saying is that it's going to be offset by tariffs, essentially. And the additional tax revenue coming in from the tariffs is going to offset the lower economy or whatnot. And it's supposed to balance itself out. That's what he's saying as far as like the budget deficit and everything else. What I will say is that if you take a look at so Elon Musk, who on the one hand I have a ton of respect for because he's done some amazing things for society, right, in various industries. On the other hand, unfortunately, he's been proven to be, and I hate to say this, but it's just true. I mean, he lies a lot, right? He lies about the Tesla roaster coming out. People put $50,000 deposits on them 6 years ago or whatever it is, and it's still not even being discussed. There's just so many times where he lies about things like full self-driving that someone paid in 2013 to have still isn't even really on the horizon realistically, even though he keeps claiming it is. Self-driving cars he said there was going to be 1 million robo-taxis on the road in the year 2020. I'm just quoting him. I'm not making that up. So he's saying he could cut $2 trillion from the government spending. That is another lie, unfortunately. And I say this, it's just math, like you were talking about before. If you actually look at the real math, it's impossible. The reason why it's impossible to cut all that money is because, and I hope I have this arithmetic right, but I looked at it a few days ago. Unfortunately, I didn't take notes. There is $1.7 trillion in what I would call discretionary spending. So what that means is education, defense, other things.
Everything else is entitlements. Everything else is locked in.
Entitlements are 72%, 72% of the budget. So if you're just looking to cut the government workers and on programs that are, that not fully necessary, you could only, if you cut 100, all defense is 100% of it is 1.7 trillion. It's impossible to cut 2 trillion unless you're willing to cut some of the discretionary and some of the non-discretionary. Now, is it possible they will cut some non-discretionary? Non-discretionary means entitlements, right? It means Medicare, Social Security, et cetera, welfare. If they start cutting those, they could theoretically get to 2 trillion. I don't believe they're going to do that.
They can't cut Social Security, Medicare,
right.
These are sacred cows.
Yeah, so if you assume that they cannot cut those and they can't touch those, it's literally, if you get rid of the rest of spending, it's 1.7 trillion. They're not going to get rid of all the education. They're going to get rid, that's impossible. They're not going to get rid of all the government spending that's discretionary. It's impossible. What are you going to do with roads, education, safety? It's impossible. So the amount that they want to, that must claim is literally arithmetic. The arithmetic doesn't make sense. Now, I will say maybe they can cut 500 billion of the 1.7. I don't know anything about the government spending, so I can't comment on what's realistic, but let's just call it 250 billion, 500 billion, which will be helpful. But if I recall correctly, the current deficit for this year is over $1 trillion, and I think it's 1.7 trillion.
It's approaching 2 trillion. I think
it's 1.7.
1.5. We were approaching. I think in my head, and I may be wrong, it's around 2 trillion.
Okay, I thought it was 1.7. So if you cut
1.7, so it was approaching 2 trillion.
So if he cuts 200 billion, 500 billion in a great day, is that really, it's slowing down the problem. It definitely is creating something, but it's not solving the problem. Now, there is a lot to be said for slowing the problem down. I'm just pointing out to everybody that what they're claiming they're going to do is literally impossible, certainly with the numbers that Musk was throwing out. I am hopeful that they will do some stuff because probably some of it needs to be done.
Yeah. These are great data points, great wisdoms. I'll tell you my position. The biggest way you could cut the budget deficit is drive the rates lower, because $36 trillion deficit, 1% a year, 1% is 360 billion.
Yep.
Right? If you're able to get the rates to a lower point, you suddenly have massive savings without gigantic cut. You're not cutting. So you're not cutting bone. You're cutting something and it might mean at some point Fed actually going back to the quantitative easing, whatever you call it, start buying some treasuries to drive yields down.
Yep.
We would welcome this on the real estate front. Question is, if they still have theoretically high inflation, can they do that? Because the tariffs, what you said previously, if you cut government spendings, I don't understand how tariffs will compensate, from the point of view that you are basically making all the goods more expensive. So you're shrinking the economy by laying off people. On the other side, you are adding cost so you're creating inflation, and at the same time you are cutting. You're gonna put things into recession way faster than you can blink.
Yeah, I was just telling you what they're saying. I don't necessarily disagree. I think there's pros and cons of tariffs, and certain, depending on how much they are and all kinds, right? So, but I think generally speaking, it's probably generally agreed upon that it's inflationary, which could be challenging. We'll have to see. Yeah. And by the way, you make a very good point about interest rates go down, the interest costs go down for the government. It's a very valid point. I don't think that's what the Doge and what Elon Musk had in mind when he mentioned the 2 trillion. So I don't think that's what they were thinking about, right? I think they're trying to cut actual government jobs and just cut fat. But there's an argument to be made if they can reduce rates by a point or two, that will, but even that will not solve the problem, right? 2 points, 200 basis points down on the treasuries, which by the way is a lot, right? Especially like
it'd be like a super holiday for the real estate.
And so, but if they get 200 basis points down, they're only solving less than half of the deficit problem, right? And then you
You know
go
what
back
this
to
means? We're past the point of no return. That's what it means.
right. So if you layer on $250 billion in savings or 500 billion, and you add on 200 basis points down in interest costs, you're now maybe saving $750 billion to $1 trillion out of the 1.7, and you're delaying the problem, which actually does have a lot of merit. You are delaying the problem, which has a lot of merit. I will argue, though, that you're only delaying the problem temporarily. They probably can't keep the interest costs low forever because that will cause other problems, right? And frankly, at that point, you're going to have less demand for the treasuries at some point, especially if you're printing the money. And at some point, that's just like, it's a temporary measure. You can't keep that permanently. It's not, the market won't allow it, right? The government doesn't have control over the market, and the market, unfortunately, a lot of the treasury purchasers are international buyers. So in a short term,
that's long gone. From what I understand, the net purchases by foreign central banks and foreign buyers, that growth long gone. At best, they're renewing their paper at best. So what you have is you have massive issuance. You have no incremental demand. That's one of the reasons the gold has gone up, right? I mean, it's one of the questions why gold is up so much is because BRICS are trying to buy up reserves, basically gold, to launch their own currency. They want to hold their foreign reserves in dollar. So that's what's happening today. And at some point you're going to face the reality. People just don't want to buy U.S. bonds. You just don't. You with that size of deficit, you just continue to print more and more dollars. So what do? Nobody wants to buy these long maturity bonds, no matter what, unless the yields are so much higher, and at that point, you have other problems. So it's I don't know.
Yeah,
you monetize your debt. You keep buying your debt almost to the point where there's no end to it.
Yeah, this is an unsolvable problem, but the one thing they can do is delay the problem, right? So if they get the deficit a little bit better in check, it can delay the problem. And by the way, for those of you who are not familiar with BRICS, it's very important to take a look at that because there is some probability it's going to be the next reserve currency of the world. And what's interesting is that it wasn't very well covered in the US, but in November, I believe it was, they actually had a meeting and actually officially started printing currency, like actual physical bills, or at least authorized the beginning of printing of currency for that new currency. So, to me, look, Empire, if you look at Ray Dalio, and if you're not familiar with him, he's a great guy if you want to understand Empire cycles, because there's cycles, just like there's an economic side, there's an empire cycle. Right now, the US is an empire. We're getting to the point at which we've kind of lasted our time, and our time is kind of up, and we're going through the normal, everything that's happening is following the typical end of empire playbook, literally, just like there's a recession playbook. And if you watch his videos, you'll learn what that means and how that's going to unfold. Nobody can tell you the timing, and the transitions can take a long time. But I'll be shocked if we're having this conversation in 30 years and the US dollar is either still fully the reserve currency, or there hasn't been a switchover, some type of switchover or transition happening by that point. It's just hard to say exactly when.
Well, that looks both scary, and it's not even clear where we're going to go from here. But from that perspective, anyway, we've had discussions. I had another great guest on the podcast. I actually have a dinner with her next week, Frances Newton Stacy. She comes on Bloomberg, on Fox Business, Fox News. And this is a pretty fundamental problem. This is, by the way, how she explained why the gold demand is so high. Is simply the BRICS are picking up all these reserves to back that currency with gold. So it's happening. If it's not BRICS first iteration, maybe second iteration. If not second, it's third iteration.
Right.
But the bottom line is, I think US is in this vicious cycle where it could shrink deficits maybe a little bit, but they're going to continue, and they're going to continue to grow, and national debt will continue to grow, and it's a devaluation of the dollar. But again, what other people are doing, right? You're going to have the interesting thing is, if it's not US, who is it going to be? Is it really going to be BRICS, which is as much as you mentioned, there's a possibility, but it feels like it's not there. It may be 5 years from now, maybe 10 years from now.
Oh yeah, no, I don't think it's quite there yet, right? I think we'll know when it's finally there. But the problem is that if you look at history, it takes typically 15, 20 years to make this transition. And by the way, the printing of the bills is part of it's part of the process, right? So if that becomes the reserve currency, that was just another step in the milestone in this transition, right? But the timing is very tough to predict.
At some point, when you don't believe into dollar and because the government continues to print, people start seeking something else. I mean, that's why Bitcoin has been running up the way it's been running up, although it's difficult to believe Bitcoin can be that.
Right. But I just want to add something else, which is really fascinating. If you look at the empire cycles, often what happens at the end of a cycle for an empire is that there is a reduction in standard of living by about 25%, which essentially means there's just inflation by 25%, right? And it doesn't necessarily, the incomes don't necessarily keep up with that level. What's fascinating is that if you look what happened from COVID and all the money printing that occurred, we actually had about a 20 to 25% decrease in the standard of living based off of how much money was printed versus how much wages have decreased. Have not kept up with the inflation. So that may have been like one of our large step ups in that process that may have already happened, and now we're all feeling it. That could be
COVID accelerated the path of degradation of standard of living.
Yeah, and that I mean, I still am very upset by the money printing, because if I had a choice and just objectively with data, you look at that scenario and say, okay, we're going to give everybody the equivalent of the unemployment, insurance payment that they would have if they weren't employed right now, which is a fraction of what you would make. Rather than doing that, they actually gave people more than their salary in many cases. And that's really was the overprinting of money, and that kind of screwed up people's incentives to go back to work and did all kinds of stuff. So it is what it is, it's done. But I think we're going to look back in history. I think that was one of the biggest US errors at the end of its empire, for sure.
You're right. Most likely you're right. I concur with you that the amount of dollars they printed during COVID was insane. It was not justified by really the pandemic. And if you give politicians the opportunity to spend money, they love it. It's their most favorite sport. And typically those in charge wind up enriching themselves and their friends more than the bottom of the economic well-being. And those folks, for those folks, it's that 25% reduction in the standard of living, while for those in the upper echelon have had nothing but great success from that spending.
Well, time will tell, because I have a lot of conversations with people who are like, the stock market's been going up so much, maybe it would have been a better move if I would have been in the stock market for the past 16 years versus doing some of this other
real estate
doing. But
I've had the same conversation.
Right. But
recency bias, but this is so wrong. It's almost the opposite. People are beginning to think that way, and this is so dangerous.
Yeah, and that's the thing. The story isn't finished yet, right? So like real estate had its hit because interest rates went up, but the stock market will eventually crash at a recession, and that correction will happen too. That correction just hasn't happened yet. And then when that happens, that'll be the level playing field for people to properly evaluate whether or not the stock market was better or not. And then possibility of the last decade will also change opinions down the road, but not in the short term,
Just on this point, and then we're going to wrap up. It's just an awesome discussion. The valuations of stock market, they're so out of sync with the discounted valuations of real estate. There's a hard cost to rebuild these assets, these multifamily properties. So on a relative basis, real estate, even though maybe we're not at a perfect bottom, but we are at a substantial discount, and it feels like the prudent folks should consider, right, diversifying out of highly appreciated stocks into what is available for sale. What's the value by today? Value by today is what's cheap and on a relative basis, way well below reconstruction cost. If you can get into these assets, maybe you don't yet have your ideal cost of money. You have sort of a higher cost of capital because the rates are still high. But you can pick up on a reconstruction basis at a steep discount. And if the rates drop, then you can refinance, right?
Yeah. There's no doubt that just from a mathematical perspective, you're 100% correct. If you're forced to do something, then real estate is, the one thing that people don't talk about, which I hate, and I actually like to point it out on these types of podcasts, is there's a crash. There was a crash that occurred in the real estate we're talking about. Most of the values were down 20 to 40%. In those scenarios, in many or most cases, most or all the equity was wiped out, right? All the invested equity. That's a reality. Nobody talks about a crash because everyone's always so positive. You go to the conferences, no one's used the word crash, but that's actually by definition, there's been a crash in terms of over 20% correction, right? So
yes, certain markets, Sun Belt markets have seen corrections to the degree, like you said,
Yeah.
25 to 40%, depending where you're at. And
yeah, it
some
depends
other
on the
markets
asset
much less,
type.
but that's been definitely at least significant correction.
Yeah, I'm just generalizing. It depends on asset type, location, asset quality. But my point being is that if you have to look at the relative value, the values in the real estate right now, I still don't think we're quite at the right time for that. But there's no doubt that the value is better in the real estate than the stock market ranges from a multiple perspective. There's no doubt.
Yeah, if you ask me this question today, what's a lot more attractive, this real estate or these, Magnificent Seven or even S&P 500? There's no doubt on a relative basis, real estate looks so much more attractive. But in the short duration, you can still see significant run up because euphoria and irrational buying can continue, right, in the stock market, while the real estate could still be in a state of a depression, in a manner of speaking. We're not depression, but we are in a state of significantly reduced valuations.
Yep. Yeah. Real estate just moves very slowly. So it makes it easier to get in and not have to worry about timing as much. But I'll leave you with this, which is I would rather be too late. I'd rather be too late than too early in real estate because it goes so slowly. And then it's the opposite for the stock market because it goes so quickly. So you have to think about that, especially if the stock market goes down or when real estate goes down. You have to play it differently because it takes so long for real estate to play itself out, and that's what we're currently waiting on. So we'll see.
Yeah, it's a great wisdom. Stock market moves way faster. I mean, it's liquid. That's another thing about stock market. It's highly liquid. You could buy when things are cheap. With real estate, you still got to go find the deal. You still got to go do a lot of negotiations, value. It takes time. Real estate moves very slow. It's a beauty and a curse in some way. In some ways, by the way, just to add on the same topic, people are asking the question, what's the difference between stock market and real estate markets? And the biggest difference, in my view, stock markets they're very efficient market, meaning the information travels fast, decisions are made very, very fast. Real estate, highly inefficient, and you can get bargains while others can't. And that's the big difference.
Yeah, that's a very good point.
Thank you, Jeremy. Greatly appreciate your time, your wisdom, your sharing. Wishing you and your family wonderful holidays. Any final thoughts? How would folks reach out if they wanted to follow you, etc.?
Yes, happy holidays to everybody, and thank you for hanging in. If you're still listening to this, hopefully it was helpful. Anyone wants to reach out to me, feel free. I'm happy to talk to anybody. My email is the best way to reach me. It's jroll, JROLL, at Roll Investments, ROLL Investments with an S.com. So jroll@rollinvestments.com.
Thank you, Jeremy.
Thanks for having me on again.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.